After a major reversal, there is a double bottom in combination with a gap down to reverse a minor downtrend and continue the larger uptrend. From this formation, a major support range is outlined. From late February to late March, FDX is on a weak upswing due to low bullish volume. More importantly, it breaches a key uptrend line originating from the double bottom. The uptrend is decisively over, as there is the usual sideways to even bearish price action in the long term. The double top hasn't conclusively completed or failed yet. It is being delayed and heavily invalidated due to even more volatile fluctuations in May, though the larger bearish context remains due to consistent bearish spikes keeping trading under the double top's lower boundary from 88.03 to 89.44, taken directly from the high and low of some candles that run through this area. These levels could be rounded off, but that would make little difference during such high volatility. At this point, it could be said the double top hasn't failed, and its bearish influence is still present. However, it has been invalidated to an extent due to continued trading over the 89 to 88 range. A clear downtrend line can mark the double top in a declined variation, especially because both downswings have high volume. This is helpful in identifying a gradual slope that continues to hold down volatile movements in the upper 80s and lower 90s. This is a great demonstration of a clear pattern being invalidated, to lose precision and effectiveness due to substantial volatility. However, the general influence of the pattern is still in effect, as price still does decline. The decline is to a much lower degree due to the aforementioned factors and a major range of support around 86 that ran through many clear swing points. The lower portion of the double top downtrend could also be considered a failed descending triangle, but that becomes a minor detail quickly left behind, as FDX returned to climbing for new record highs. After a sizable correction, a bull hammer in late January provides a crucial reference for support at round numbers near its closing and low prices. As bullish volume increases slightly to develop the upswing, a long-term view reveals the 120 range to be the site of the major 2013 bullish break and, more importantly, a prior all-time high range of major resistance. These factors add to the bullish background and increased chances of a major uptrend emerging soon. 130 to 129 is an important range to take into account, as it had been the site of major price action that included the large late August 2015 drop and the base of a failed descending triangle. Once again, it is a case where general descending triangle price action takes place to technically reverse an uptrend. Theoretically, only the downswings following an initial bearish reversal are part of a descending triangle. But as seen several times, this makes little difference since the pattern fails. If a pattern such as a descending triangle forms in a less favorable context, such as in an uptrend here, it is not to say it is incorrect. The price action is strictly correct. However, the broader context is in opposition, and that increases the chances of pattern failure, such as here. Attention should always be paid until conclusive trading completes a pattern as a success or a failure, regardless of the short, medium, and long-term context. In addition to the base of the failed descending triangle, the overall range can be adjusted to take into account more recent 3 methods falling price action, and a recent downswing in the midst of high volatility. These adjustments still line up with reference points from the failed descending triangle, but to a lesser degree. They also take into account the minor gap up in late October 2013, following a bullish surge. It soon becomes apparent an inclined double bottom is in development to direct the majority of market attention to the area around 134.30. Despite natural resistance, bullish sentiment remains, and a successful double bottom can still be possible, especially if a bullish spike can lead to 3 methods rising price action to conclusively clear 134.30. Towards March, constant bullish volume at normal levels leads to the gradual completion of the double bottom in the last 2 days of February. Next, a gap up begins to fill, and trend lines from the double bottom mark areas of key interest. Wider gap fill support holds, and this is derived from the flat range prior to the gap up. Now it is the inclined double bottom and recent gap up fill against the moderate to strong resistance of past highs, and a stable downtrend. The bullish stance wins out in the long term to continue much higher. During the break towards the 200s and beyond, the 2016 gaps and highs demonstrated excellent role reversal in an aggressive uptrend that was further evidenced by the late 2016 gap up that was not filled. The longer term has certainly given way to gradually more neutral to increasingly bearish price action within some clearly defined ranges. This is another one of those situations where a downtrend line is part of a potential descending triangle. Despite the rapid drop, the wide range of support has not been cleared yet for the descending triangle to be declared successfully complete. Over the past 5 days, there has been clear 3 methods falling price action. For a short-term continuation that also breaks under 215 for a likely longer-term bearish continuation. Short-term sentiment has been marginally bullish and weak as shown by the low green volume and general lack of consistent green candles, closing over the 226 to 215 range. This wide range and the fluctuations over the past 2 months have complicated analysis in the short term, as it would appear the large descending triangle has begun to be invalidated or even failed. However, the longer-term context should also be kept in mind, especially in light of the shorter-term bearish spike following a minor double top in November. The drop is strong as expected due to being such a large descending triangle. In hindsight, the 226 to 215 boundary was merely residual support to temporarily hold trading in a horizontal resting phase in a larger bearish continuation that just happened to be part of a descending triangle. The minor upswing never decisively cleared out of the 220s. In short, this was essentially a major correction accelerated by a descending triangle that completed with 3 methods falling price action on a large scale. The trend was sustained longer due to breaking the earlier uptrend line with a gap down in late 2018. This resulted in a temporary downward overextension, which is why subsequent downswings were much smaller in comparison. Interestingly, the earlier downtrend line that intersected with the late 2016 gap up formation directly crossed over the early 2020 bullish reversal point that took place in the major ranges from years past during the partially invalidated double top in 2012. Another interesting observation was the major reversal was another inclined double bottom that also had a gap up follow its completion. It also has a triple top within its upper boundary, which is quite rare in comparison to the usual 1 or 2 downswings in the middle of a double bottom range. The downtrend line from the descending triangle intersects exactly where the uptrend faces resistance in the 200s range. After this area in price and time pauses the steep incline, the uptrend resumes with strength, as highlighted by another case where a downtrend line from an old pattern is crossed to mark the continuation of a new aggressive uptrend.